If investing feels like something smart people do with money you don't have in markets you don't understand, using terminology specifically designed to make you feel excluded, you're not wrong about any of that. And the investment industry has spent decades building a professional language, a credential system, and a media ecosystem that communicates intentionally or not that investing is too complex for ordinary people to do without expert guidance. And it isn't. It isn't. The actual mechanisms of investing that produces wealth for most individual investors can be understood in about 45 minutes, implemented in about an hour, and maintained in about 15 minutes per year. The complexity you've been presented with is not the complexity of the things itself. It's the complexity of a profitable industry built around a fundamentally simple process. And here's the simple process, the one insight that changes everything. Before any mechanics, the single insight that makes investing approachable for people who find it overwhelming. You do not need to understand how investing works to benefit from it. You need to understand enough to set up a system that works while you're doing other things. And that's it. The goal is not to become someone who follows markets or reads earnings or reports or has opinions about sector rotation. The goal is to become someone who has money growing continuously in the background without requiring ongoing attention. Those are different goals that require different knowledge levels. In the second one, which is the goal that actually serves most people, it requires dramatically less knowledge than the investment industry professional communicates suggest. The comparison that helps, you don't need to understand how internal combustion engine works to drive a car. You need to know how to start it, steer it, and keep gas in it. Investing for wealth building works the same way. You don't need to understand pricing models or corporate bonding rates. You need to know how to open an account, put money in, and let it grow. And what you're actually doing when you invest, an investment is a purchase of a claim on future economic value. When you buy a share of stock, you own a small fraction of a real business, its assets, its future earnings, its growth. And when you buy a bond, you're lending money to a business or a government and receiving interest in return. When you buy an index fund, you're buying a small fraction of smalls. Hundreds of thousands of businesses simultaneously. And the reason investing builds wealth over time is that produces businesses generate profit, and a portion of that profit flows to the owners of the business, which includes anyone who owns shares. The stock market's long-term return approximately 10% per year before inflation and 7% after inflation. Historically, over the past century, reflect the growth of real businesses that produce real goods and services and return real profits for their owners. You don't need to predict which businesses will do well. The index fund approach buys all of them in proportion to their size, capturing the return of the economy as a whole rather than betting on any individual company. When a company fails, it weighs in the index strengths. And when a company grows, it weight increases. The index self adjusts to reflect economic realities over time and without requiring any decision from you. The only three accounts you need to know about. The investment industry offers hundreds of accounts types. You need to understand three. The first is a 401k or a 403b. The retirement account offered by many employers that allows pre tax contributions from your paycheck up to an annual limit, usually 23,500 in 2025 it was anyways. And the money grows tax deferrable or tax deferred, meaning you don't pay taxes on gains until you withdraw in retirement. If your employer matches contributions, this match is free money, a guaranteed return that ranges from 50 to 100% on the matched amount. Contributing enough to capture the full match is the highest return financial action available to most working people. And the second is the Roth IRA, an individual retirement account you open yourself with after-tax contribution up to $7,000 per year in 2025. The money grows tax-free and qualifies withdrawals and retirement are completely tax-free. The Roth IRA is the most powerful tax advantage account available to most middle income earners because the tax-free growth compounds dramatically over long time horizons. Open one at Fidelity, Vanguard, or Schwab, and all three have no account minimums and no account fees. The third is a taxable brokerage account, the same institution, no tax advantages, no contribution limits, and no withdrawal restrictions. This is where investing happens after the tax advantages accounts are maxed out or for goals with shorter time horizons than retirement. Less efficient than the first two, but simpler and more flexible. The sequence: contribute to the 401k up to the employer match first, then max the Roth IRA, then increase the 401k to the annual maximum, then taxable brokerage. This sequence maximizes tax efficiency without requiring any sophisticated tax knowledge. And what to buy inside the accounts too. This is where most investing content loses people. The fund selection conversation buries beginners in the options that feel consequential and are, for practical purposes, nearly identical. And the answer for someone who wants to invest without thinking deeply about investing: one fund, a target date retirement fund from Fidelity, Vanguard, or Schwab, matched to your appropriate retirement year. Fidelity Freedom 2055 is if you plan to retire around 2055, for example. This single fund contains a diversified mix of domestic stocks, international stocks, and bonds that automatically rebalances and shift towards lower risk allocations as the target date approaches. And the expense ratio is low, typically 0.10 to 0.15% per year. And the diversification is broad, and the management is automatic. And that's it. One account type appropriate to your situation, one target date fund, automatic contributions, and done. And for someone willing to engage slightly more, a three fund portfolio: a Fidelity Total Market Index Fund, a Fidelity Internal and International Index Fund, and Fidelity US Bond Index Fund, and proportion of roughly 60 to 70% domestic, or 20 to 30% international, and 10 to 20% bonds, depending on risk tolerance and time horizons. Same institutions, comparable expense ratios, slightly more control over the allocations. And for anyone with a time horizon of 20 or more years, the bond allocation can be a minimal because long time horizons absorb volatility that short time horizons cannot. And both options, target dates or three fund, will produce better long term returns than the majority of actively managed funds at a fraction of the cost. The evidence of on this is overwhelming, consistent across every time period studied, and routinely ignored by the industry that profits from the complexity that obscures it. The market will drop, and here's what to do. At some point after you start investing, the market will drop. Maybe 10%, maybe 30%, and maybe more. Your account balance will be lower than it was, and the balance financial news will be alarming, and people around you will express concern. And the correct response to this event for someone with a long investment horizon and automatic contributions is nothing. Market downturns are not losses for long term investors, they are discounts. The same shares you were buying last month are now available at 20 or 30% below last month's prices. And the automatic contribution you make during a market downturn buys more shares than it would have bought before the drop. Those shares recover their values and grow further than when the market recovers and when it has done after every decline in its history. The investors who achieve the worst long term outcomes are almost universally those who stop contributing or sell their holdings during downturns, converting temporary paper losses into permanent realized losses by leaving before the recovery. The investors who achieve the best long term outcomes are almost universally those who continue to contribute automatically throughout market cycles and leave the investment alone. You don't need to understand why markets drop. You need to understand that they recover, and that's your plan for when they drop, is to do nothing and keep contributing. The setup that takes an hour to open a Roth IRA at Fidelity, Vanguard, or Schwab, whichever interface feels more navigatable, and fund it with whatever you can contribute this month. Even if it's $50, set up an automatic monthly contribution for an amount you can sustain. Select a target date fund matched to an appropriate retirement year. Confirm that your employer's 401k is contributing at least enough to capture that full match. That's the complete investing setup for someone who hates investing. Total ongoing maintenance, logging in once per year to confirm the automatic contribution are running and the allocations haven't drifted significantly from your intentions. The investment industry wants you to believe this requires more monitoring, more expertise, and more active management and more professional guidance, because more is what produces professional fees. The evidence does not support more. The evidence consistently and overwhelmingly supports less. Lower costs, broader diversifications, longer time horizons, and the patience to leave the system alone. While it does what compound returns have always done, when given enough time, you don't have to love investing to build wealth through it. You just have to start. Thanks for watching. If you like this video, check out this video to the right. If it was, well, check out this video to the right. And if you found a lot of value to this video, please subscribe. We would love to have you on the channel. Thanks for watching. We'll see you on the next one.